Hi, I'm Monk and this is the Monk Way. Let's look at the best index funds for the passive investor. These are all funds that I would personally buy. I'll go over why these are the best index funds to buy, expected returns, and the best method to buy in, including a strategy to protect against a possible market crash. This is very important to learn for every type of investor. Subscribe and hit that bell for more stock market videos. I make them every day to keep you invested, and leave a like if you enjoy passive investing. Make sure to check out my stock market group. I show members all my trades with instant email updates. My portfolio is over $300,000 and 50% of it is in index funds. If you want to know exactly when I buy and sell these funds, check out the link in the description or comments below. It's 50% off for a limited time, so don't miss out. Let's look at why you should invest in these index funds. An index fund is just like a stock, except it holds many stocks in one. This is why it's called an index, because it's an index of many companies. Warren Buffett, the best investor of all time, always says to buy the index. He's referring to the S&P 500, which contains 500 of the biggest American companies. An index fund is perfect for passive investing because they are so diversified. Imagine owning 500 companies at once. This is almost impossible to do without buying an index fund. This way, the stronger stocks make up for any lagging companies. If a few companies actually crash, but the rest are doing fine, the index will still be stable. This is why one of the best investing strategies is to buy an index and keep adding to it for life. The average investor will not beat the index, even the professionals have trouble doing this. Over the past 15 years, only around 5% of all money managers beat the market. This means you have a 5% chance of beating the S&P 500, even leaving your money with people who do this full-time. The chances of an individual investor beating the market is even lower. This is why the average person should just invest all their money in the index, with a bit of money every month. Let's look at the best index funds. We'll start with the most popular and well-known index fund, the S&P 500. This fund can be purchased in America with the symbol VOO, and VFV in Canada. Like the name suggests, it has about 500 American companies. In the past year they went up 3%, 24% in 2 years, and 51% in 5 years. They also pay an 1.62% dividend. The smart investor would reinvest this, giving you more returns overall. As we can see, they really dipped recently. This is because most American stocks went down in recent weeks. I want to show you guys that this happens even with a safe index. Before the dip, they had a return of over 70% in the past 5 years, around 80% if you reinvested the dividends. Over a period of 100 years, this fund has an annual return of 10% a year. This means you have a very good chance of getting a 10% a year return if you just left your money in this fund. This requires not selling when a market crashes. Over 10 years or longer, you'll likely get a 10% a year return. 10% a year might not sound like much, but with compounding, we can see great returns. If you can save just $300 a month and invest in this fund every month, you'll be a millionaire in 40 years. This is $1 million after inflation, or 1.9 million of real money, which is worth about $1 million today. If you want to get rich younger, just $500 a month will become $1 million in 34 years. If you can save $1,000 a month and invest it, it'll only take 26 years. The bigger companies have a bigger weight in the portfolio, meaning their movements matter more. Let's look at the top companies in this index because you still want to invest in companies you trust. The biggest companies on top are Apple, Microsoft, Amazon, Google, Facebook, and many more. It's a mix of many sectors, a lot of technology, consumer products, telecommunications, and others. This huge mix of 500 companies mean much less risk. Imagine putting all your money in 2 companies. Let's see what happened to our money if we bought Facebook and Amazon instead of the index in the past month. Facebook went down 11%, Amazon went down 18%, for a total of 14.5% loss in 1 month. The S&P 500 went down 8%. This means single stocks went down almost twice as much as the index. Although many stocks in the index dropped because the whole market was down, there were still enough safer stocks to not drop as hard. Let's take a look at how much of a dip this index takes during a recession. We are currently in a correction, meaning drops of around 10%. We saw the market drop 3 times during 2018, shown here. 10% in the beginning of 2018, it bounced back but dropped 8% again here, and in the past week, it dropped 9%. We can see how investors feel about the market as a whole. When things start dropping, this causes many people to pull their money out of stocks in general. This has a huge cascading effect which could lead to a correction or crash. In 5 years we can see less volatility. There was a 7% dip in 2015, an 11% dip in 2016, it soon recovered. This means we're in a huge bull market that could be coming to an end. It could also mean this 2018 dip might recover. Now let's look at the long-term history. We saw a 16% dip in 2011. This was almost a crash but it recovered. The previous crash we had was in 2007 to 2009. This lasted a bit over a year before it started going back up. The market dipped 56% at the lowest point. If you bought at this highest point, it would take almost 6 years before breaking even. We see something similar in the 2000 crash. It went as low as 45% in the red. If you bought at the peak here, you wouldn't have been in the green until 2013. This is why a better strategy is to dollar cost average in the market. This means investing a chunk of your money every month or few months. Let's see what happens if we did this instead. In 2008, the price was $141 at the highest point. Buying here means you had to wait until 2012 before it reached that price again. Let's see what happens if we bought in over a 12-month period instead. The first month being $141 on May 2018, $127 in June, $125 in July, $128 in August, and so on. Because we bought in during a crash, we had much lower prices near the bottom at $80 a share. In the 12 months we bought in, we had an average price of $102. This means we got in at $102 instead of $141 just by slowly buying in with the same amount of money. Now we are profitable by September of 2009, meaning we're in the green 3 years earlier. This is a 160% return in 2018, even buying right before a market crash, compared to an 88% return if you bought it all at once in 2008. This is why dollar cost averaging in during volatile times is a good idea. The market hasn't crashed in almost 10 years, and the average crash happens every 10 years. I would personally save more and more cash at this point, and start slowly investing in if it dips 20% or lower. A quick summary. This index returns 10% a year, but only if you can leave it in for at least 10 years or longer. This index doesn't dip as hard as single stocks because it's a combination of 500 companies. A crash can happen causing a dip of 20 to 60% of your money, so it's a good idea to average in when buying this. This is the most common and recommended index for the average person who doesn't want to pick stocks. I have 20% of my money in this index and wouldn't mind 50% or more in this. The second index I like is the Nasdaq 100. This fund can be purchased in America with the symbol QQQ, and XQQ in Canada. Similar to the S&P 500, this index has 100 American companies. The Nasdaq 100 is more technology-focused compared to the S&P 500. In the past year, they went up 10%, 40% in 2 years, and 100% in 5 years. They have a smaller dividend of 0.8%. This made more money than the S&P 500 in the past 5 years. This also dipped in recent times. We see a similar pattern here. There's less history with this index, but in the past 10 years, they had a return of over 400%. This is double the S&P 500, which returned 200%. This is due to this index having less stocks, so bigger companies can move it higher. Also because technology stocks has been going up a lot faster than any other sector. It's possible this index could go up an average of 15% a year or more, giving investors a much bigger return. It would only take 28 years with $300 a month to become a millionaire with such returns. This comes at higher risk since 100 companies, mostly focused on technology, is not as safe as 500 diverse companies. This index contains many of the same big companies like Apple, Amazon, and Microsoft. We have companies like Nvidia, PayPal, and some non-technology ones like Starbucks, Pepsi, and Costco. Let's look at the dips in the past years. In the past year, they had very similar dips to the S&P 500, but a bit more volatile when it goes up and down. Back in 2008, it dipped 50%. This is actually a lower dip than the S&P 500, and it recovered faster around 2010. But in 2000, it dipped a huge 78%, and hasn't recovered until 2015. That's 15 years if you invested at the top all at once. This is because that crash was caused by technology and the internet, but this shouldn't happen again to the same degree. This fund is more risky than the S&P 500, but if you truly believe in technology, it might be a better fund for you. I have 30% of my money in this fund. Some other funds of interest include the Vanguard Total World Stock Index. This can be bought with the symbol VT. It has a 1.92% dividend, which is pretty good. It's up 19% in the past 5 years, and 100% in 10. This is a much more diverse fund, which explains the lower increase in price. It contains a mix of stocks from all around the world, with over 8,000 companies in one fund. This is safer if you don't want all your money in America. 100 years of history doesn't mean American stocks will always keep going up. Another fund is SCHWAB US Dividend ETF, with the symbol SCHD. This one contains over 100 companies with good dividends. It has a 2.4% dividend, which might be appealing to prepare for a market crash. In the past 7 years, it's up 92% compared to the S&P 500, which is up 115%. Less risk and less gains but higher dividends. This fund contains big dividend players like Procter & Gamble, Verizon, Pfizer, Pepsi, and many more. An ETF for the gambler who believes in marijuana stocks is MJ. This one is up 23% since 2015, but this is due to the recent marijuana dip. This contains big companies like Canopy Growth, Aurora Cannabis, and Tilray. For the investor who likes weed stocks but don't want as much risk, weed could be a sector that goes up 100% in the coming years. All these index funds has low fees for what you get. VOO has an extremely low 0.04%. QQQ is a bit higher at 0.2%. VT is 0.1%. SCHD is low at 0.07%. And MJ is pretty high at 0.75%. The benefit of owning these funds is the low fee, and it's very simple to buy and sell them whenever you want. Make sure to join my stock market group to see exactly when I buy or sell these index funds. I have 50% of my money in these funds, so you'll get a complete transparent look at how they perform, with instant email updates of every buy or sell, along with my $300,000 portfolio. Recent winners include Canopy Growth and Aurora Cannabis, huge spikes from these wheat stocks. It's 50% off, but this coupon only lasts a little while longer. Look in the description or comments to join now. Get in before it's too late and full price for life. Subscribe and hit that bell for more investing videos. I make them every day to teach you something new, and leave a like if you learned something. Keep watching to buy the best index funds, the Monk way.